Anyone with even a passing interest in financial investing has most likely heard the term market at some point. Investors should always seek awareness of these financial terms, whether in the context of stocks or real estate conditions, to have a firm grasp of their monetary options down the line. Of course, the stock market can be as large and complicated as investors want it to be. It can, however, be broken down to better understand how things work, just like everything else. Moreover, even the market can be divided into several submarkets, which appears to be the impetus for one of today's most heated debates: primary versus secondary markets. Instead of viewing primary and secondary markets on their own merits, investors should focus on how they interact with one another, which is why the following outline was developed. New and experienced investors can ensure they have a strong working knowledge of financial markets by using today's video as a helpful guide in understanding primary and secondary markets. Hello, this is the Wealth Moguls, and welcome back to the channel. If you are new here, please make sure to subscribe to the channel and turn on the notifications to be notified of every upload. To begin, what exactly is the primary market? The primary market is not a physical market in the sense that we normally associate with Wall Street. Instead, the primary market refers to the process by which securities, such as stocks and bonds, are created and sold for the first time. It is the primary market in which stocks and bonds are traded publicly for the first time. As a result, instead of buying and selling securities from one another as on the secondary market, investors buy securities directly from the banks in charge of underwriting the initial public offering, IPO. When a company decides to go public, it will generate cash through an initial public offering, IPO. As a result, the soon-to-be public company will hire several underwriting firms to determine the financial details of the upcoming stock debut, including the issue price. Once the issue price has been determined and the company is ready to go public, investors can purchase shares of the company on the primary market from the bank. According to Robert R. Johnson, professor of finance at Creighton University in Omaha, Nebraska, a primary market is an excellent place for investors to acquire stock. In addition, according to Johnson, studies have shown that the average initial public offering outperforms the broader stock market. Johnson cautions investors not to get too excited without doing their homework. Before you rush out and buy every IPO you can get your hands on, consider how those returns are achieved. While the average return on IPOs may outperform the broader market, the average is driven by a few outliers. According to Johnson, the median IPO return, defined as the IPO where exactly half of the IPOs return more and exactly half of the IPOs return less, is lower than the broader market. After all is said and done, the primary market is a catalyst for investors to purchase shares of a company for the first time. Similarly, businesses and governments may issue primary market bonds to raise capital for their own ventures. Whatever security is purchased, it is important to remember that securities are purchased directly from issuers on the primary market. What exactly is the secondary market? To clarify the primary versus secondary market debate, the secondary market is more commonly referred to as the stock market. It is the secondary market where investors trade among themselves on all major indices, including the New York Stock Exchange, NASDAQ, and all major exchanges worldwide. This is an important distinction because securities are traded on the secondary market without any involvement from the companies that issued them. So, while the primary market is the source of securities, bonds, and stocks for purchase, the secondary market is where the securities can be freely traded amongst new and initial investors. For example, assume an investor wanted to buy Apple Incorporated, NASDAQ AAPL stock, on the secondary market. Any purchase order would acquire the specified shares from another investor rather than the company. Simultaneously, anyone selling on the secondary market is selling their shares to another investor. However, it is worth noting that the secondary market can be further subdivided into two subcategories: auction markets and other markets. When most people think of financial markets, they think of the stock market. We'll go over each secondary market subcategory shortly, but for now, please hit the thumbs up button and feel free to share your thoughts in the comment section below. While we understand the fundamental characteristics of both primary and secondary markets are typically larger than primary markets. This is partly due to its widespread accessibility. As more potential investors enter the market is bound to be fragmented to be better understood. As previously stated, the two primary subcategories of the secondary market are auction markets and dealer markets. Auction market. The most well-known example of an auction market is the New York Stock Exchange, NYSE. As their names imply, auction markets operate similarly to the auctions with which most of us are familiar. However, auctions occur as part of the secondary market between investors looking to buy and sell. No businesses are involved. Instead, participants gather to announce their preferred bid and ask prices. Bid and ask prices, also known as the prices they are willing to buy and sell, eventually combine to form a more concrete figure. Thus, an efficient market should eventually prevail if everyone declares their terms. In theory, investors are not required to seek out the best price on the secondary market. The unique coverage of buyers and sellers in auction markets will inherently result in fair prices for everyone. In an ideal world, both buyers and sellers would submit competitive offers at the same time. When all bids have been submitted, the auction market will consider the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When bids and offers are matched, transactions are completed, and everyone is pleased. Dealer's market. While auction markets necessitate the coverage of investors, dealer markets are typically conducted electronically via individual markets. For example, on the Nasdaq, dealers keep an inventory of securities, not the least of which they are ready to trade with other investors at any time. Dealer markets are facilitated by dealers announcing the prices at which they are comfortable buying or selling specific securities. To be clear, the dealers will bet their own money to provide liquidity for subsequent investors. In exchange, dealers profit from the spreads at which each security is bought and sold. Dealers practice complete transparency and display prices for all to see. Transparency serves as the primary mechanism for dealer markets, generating competition. If nothing else, the dealer market is heavily reliant on the competition. In theory, competition among dealers, for example, should provide investors with the best possible prices. Let us now discuss the distinctions between primary and secondary markets. While the primary and secondary markets are easily confused, there are several key differences to be aware of. Here is a list of the most important distinctions that investors should be aware of before investing in either the primary or secondary market. The primary market is where new shares are sold for the first time, whereas the secondary market allows investors to trade previously issued securities among themselves. Transaction type. Investors purchase securities directly from issuers at the initial public offering (IPO) in the primary market. On the other hand, the secondary market sees investors trade shares on today's most prominent indices. The primary market is sometimes referred to as the new issue market (NIM), while the secondary market is the aftermarket. Security sale rate. Securities can only be sold once on the primary market, but they can be sold indefinitely on the secondary market. Payment party. Companies, new IPOs, profit from the sale of shares in the primary market. Investors are given access to sales profits in the secondary market. Price fluctuation. Underwriters of initial public offerings, banks, act as intermediaries on the primary market, whereas brokers act as intermediaries. Related parties. Primary market sales correspond to fixed prices. Sales in the secondary market fluctuate due to a variety of factors. Share path. Shares cannot be traded on the secondary market until they have first been issued on the primary market. Overall, while not all of the activities that occur in the markets we have discussed affect individual investors, it is beneficial to have a general understanding of the market structure. The manner in which securities are introduced to the market and traded on various exchanges is critical to the market's operation. Imagine if there were no organized secondary markets. You'd have to personally track down other investors just to buy or sell a stock, which would be a difficult task. Indeed, many investment scams revolve around securities with no secondary market because unwary investors can be duped into purchasing them. Markets and the ability to sell a security are often taken for granted, but without them, investors have few options and can end up with large losses. Therefore, when it comes to the markets, what you don't know can hurt you, and a little education might save you some money in the long run. And that's it for today's video. Please make sure to subscribe to the channel and turn on notifications to be notified of every upload. This is The Wealth Moguls, and we will see you on our next video. Thank you for watching.